Welcome to the Riskwiser Zone, the podcast where we dive into the latest developments in the world of technology, finance, and risk management. I'm your host, Louis, and we're glad you're joining us today. We're starting off with a story that's been making waves in the tech community: the security risks associated with AI-powered browsers. A recent article highlighted the vulnerabilities of these systems, using the example of Perplexity's AI browser, Comet, which has been found to have some significant flaws. Now, before we dive into the details, let's take a step back and look at the bigger picture. AI-powered browsers are designed to make our online experiences more efficient and personalized. They can help us navigate through vast amounts of information, automate routine tasks, and even provide us with recommendations based on our interests. However, as with any new technology, there are also risks involved. In the case of Comet, it appears that the AI system is vulnerable to malicious instructions that can be hidden in plain sight, literally anywhere on the internet. This means that hackers could potentially exploit these vulnerabilities to gain access to sensitive information or even take control of the user's device. The article highlights several key issues with Comet's design, including a lack of effective spam filtering, overpowered AI capabilities, and a failure to keep different types of input separate. These flaws can allow malicious actors to manipulate the AI system into doing their bidding, often without the user even realizing what's happening. Now, it's worth noting that Perplexity is not the only company working on AI-powered browsers, and this is an industry-wide issue. Other companies are also grappling with these same challenges, and it's likely that we'll see more stories like this in the future. So, what can be done to address these risks? The article suggests several potential solutions, including building better spam filters, implementing stricter permission controls, and designing AI systems that are more transparent and accountable. As we move forward into a world where AI-powered browsers are becoming increasingly common, it's essential that we prioritize security and responsible design. This means that companies need to be proactive in identifying and addressing vulnerabilities, and users need to be educated about the potential risks involved. We'll be exploring this topic further in future episodes, including discussing the implications for investors and the broader tech industry. But for now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and risk management. Our middle segment today is all about a significant development in the cryptocurrency space, particularly with regards to its adoption by traditional financial institutions. You might recall that not too long ago, cryptocurrencies like Bitcoin and Ethereum were met with skepticism by many in the financial sector. However, as we've been following on this show, there's been a notable shift in how these digital assets are perceived and utilized. A prime example of this shift is JPMorgan Chase & Co.'s recent announcement to accept Bitcoin and Ethereum as collateral for loans. This move marks a substantial step forward in the integration of cryptocurrencies into mainstream finance. By recognizing these digital assets as eligible collateral, alongside traditional assets such as stocks, bonds, and gold, JPMorgan is essentially acknowledging their value and stability in a way that was previously unheard of from such a major financial institution. It's also worth noting that this decision comes after years of skepticism from JPMorgan's CEO, Jamie Dimon, who once famously referred to Bitcoin as a pet rock. However, the bank's stance has evolved, reflecting the changing regulatory landscape and growing institutional interest in digital assets. This development isn't isolated to JPMorgan. Other major financial players like Morgan Stanley, State Street Corp., and Bank of New York Mellon Corp. are also expanding their crypto services. The Trump administration's supportive stance on cryptocurrencies and recent regulatory adjustments have certainly played a role in encouraging these banks to deepen their involvement with digital assets. As we analyze this trend, it's crucial to consider both the opportunities and risks associated with the increasing adoption of cryptocurrencies by traditional financial institutions. On one hand, this integration could lead to greater legitimacy and stability for digital currencies, potentially opening up new investment avenues and broadening their appeal. On the other hand, it also introduces these assets to a more regulated and possibly volatile environment, which could impact their value and usage. In conclusion, JPMorgan's decision to accept Bitcoin and Ethereum as collateral is a significant milestone in the evolving relationship between traditional finance and cryptocurrencies. As this space continues to develop, it will be interesting to see how other financial institutions respond and how regulatory bodies choose to oversee these digital assets. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's episode with a look at the latest market news and trends that could impact your investments. We've been following the story of the U.S. Federal Reserve's potential interest rate cuts and how it could affect emerging markets like India. According to recent reports, the Fed is expected to take a more dovish stance, which could lead to increased foreign capital inflows into Indian markets. This, combined with progress in India-US trade talks and a possible breakthrough in US-China trade negotiations, has investors optimistic about the future of Indian equities. However, it's not all smooth sailing. Crude oil prices have surged 5% due to new US and EU sanctions on Russian oil majors, which could lead to tighter global supply and rising inflation risks. Indian refiners are preparing to cut imports of Russian oil to comply with the sanctions, which may weigh on India's import bill and fiscal position. On the corporate front, second quarter earnings have exceeded expectations so far, with the defense sector taking center stage. Companies like Mazagon Dock and Bharat Electronics Limited are set to report results, with focus on government orders and new contracts. Other key companies, including Kotak Mahindra Bank, PNB Housing, IOC, Coal India, Adani Power, Dabur, DLF, ITC, Manappuram Finance, BHEL and NTPC will also announce their earnings. Foreign investor sentiment has shown early signs of stabilizing after months of selling, with FIIs turning net buyers of Indian equities worth Rs 621 crore on October 24. However, it's essential to remember that market trends can shift quickly, and investors should remain cautious. In conclusion, the Indian stock market is poised for a potential rally, driven by optimism over easing global trade tensions and expectations of a rebound in corporate earnings. However, investors should be aware of the potential risks and challenges, including rising crude oil prices and geopolitical uncertainties. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.